Yeah, so as a strategist, I don't make recommendations or provide advice, but what I will say is at the bottom of this correction at 4,800, while everybody was lowering estimates and lowering targets, I came in and raised my target from 7,500 on the S&P. I was already a high on the street, I think, and raised it to 8,000, raised my NASDAQ target from 25,000 to 27,000. Sentiment had just gotten so bearish. People were saying the top is in, etc. And I continue to say we're in a final melt up of a soon to be 43-year secular bull market. So I think you've got a good ways to go before we top. I do think we'll top this year and could top as soon as this summer, but we're not there yet. So I'm still saying this thing has plenty of legs ahead. And of course, you've got plenty of uncertainty out there due to the tariffs and, what's going to come of that and what that's, the impact we're going to have on the economy as a result of the tariffs. There's plenty of uncertainty out there, and I'm a contrarian, and contrarians are very much driven by behavioral economics or sentiment. And at this point, sentiment is still very negative. It was extremely negative back, a month ago. And now although we're seeing the retail side getting more bullish, the institutions are still fighting this thing. So there's what I call a big wall of worry to climb. That's very important in my work. At the same time, I think you're going to have, in spite of all the worries right now, I think you're going to have sharply lower interest rates as we go through the balance of this year. I think you're ultimately going to have the Fed come in and ease. I don't worry about consensus view of whether the Fed's going to ease or whether rates are going up or down. My contrarian views are oftentimes at odds with the consensus. So I am actually calling for a recession. I've said many times in recent times, we're either in recession now or we're darn close. We're heading for one. So that may sound kind of contradictory to my forecast, but I think weaker economy actually causes sharply lower rates and greater odds that the Fed's going to have to come in here, and not with one cut or two cuts, but a lot more ease ahead. So that's a big part of it. Again, because institutions are positioned either defensively or bearishly, you're going to have to see them adjust as the tape moves up. And again, with how I approach things, so much of the street and retail investor both reacts to the tape. So when it was going down, they get more bearish. When it's going up, they get more bullish. I tend to reverse that and get more bullish as it's going down and more bearish or cautious as it moves up. I think you're going to see in the next several months an all-in mentality out there. You're going to see a very different viewpoint than we have right now. I think the narrative that's going to drive this last leg into the top is going to be this idea that as the Fed comes on board and has to play catch up in terms of ease, as they see that the economy is worse than they expected, the narrative on the street is going to be rates are falling and falling quite dramatically. The wind is at our backs, the Fed is easing, and they will look over the trough of those weaker earnings that currently are being discounted. So I think you'll see, not that narrative will prove true ultimately, because I think we are moving towards something even worse, but that narrative I think will drive this last leg. Yeah, we have what I call have and have not economy. You've had the higher income groups have kept this thing afloat while half the economy, half the population is struggling just to put food on the table and, meet their monthly budget. It's worsened throughout this last several years since the pandemic. I think we're still okay in terms of holding things together so it'll look like a soft landing for the next several months. But I think we are moving towards a hard landing because ultimately you're already seeing signs that higher end of the better end of the economy is starting to slow down as well. And we're seeing it in lots of the soft numbers, consumer confidence, we're seeing it in delinquencies, etc. The signs of what we see before we enter a recession or as we go into a recession. So those things cause me to be concerned that that's what's happening. As I say, this cycle, we are going in with more leverage than we've ever had before. 2008-9, we obviously had the highest leverage at that time, and look what it did. We're way beyond that in terms of global debt, in terms of derivatives, and I consider leverage on the financial system as debt. We're talking about $330 trillion of global debt. I realize a lot of it is sovereign, but it's global debt. And we've got derivatives many-fold what it was, 15 years ago. So we're going into this cycle far more leveraged than even the 2008-9 cycle. What I learned in business school anyway is that leverage works both ways. On the way up, it can really enhance returns. On the way down, it can really slam you. And I think that's the biggest thing, is it can turn a recession, a normal recession, into something far worse. And that's what I think is likely. Now, on top of leverage, we don't focus on this much. People don't talk about it much. But the pandemic really did add fragility to the system. We never before saw money printed like it was. We had $5 trillion in terms of the Fed's balance sheet being expanded. In 2008, going into the financial crisis, the Great Recession, we had Fed balance sheet of $875 billion. After the pandemic, we were up to $9 trillion. That's just a phenomenal expansion. And obviously, we saw similar around the world. So we are obviously in a place that's very different than ever before in terms of risk. And I just think if this thing follows the script I'm calling for, you're just going to see this thing unwind very quickly. So you have excessive leverage, unlike ever before, combined with fragility in the system caused by the pandemic, not just the money printing and the debt, but small businesses are struggling to get by because they can't find people to work. I mean, things changed a lot, and they have not really come back around yet. So under the surface, I think there's more fragility than maybe the statistics show. You've got, companies are leveraged up trying to manage through this. And then, what you've got in Europe, what you've got, China obviously is very imbalanced. Japan now with their rates exploding upward after following that ZERP policy forever and thinking they could hold things down. Well, the rates are breaking out. That's going to be a problem, I think, not immediately, but I think they will be one of the significant stories in the bust. So it's a global bust. Again, I think it's mostly next year. I define a global bust as something greater than a recession, but it comes with a big banking crisis globally, financial crisis globally, and a pretty hard landing in the economy. If I'm right about a bust next year, you could see double-digit unemployment. And nobody on the street is looking for that. That's why I say I have both the most bullish forecast on the street, but also the most bearish out there. Again, it's why I fault Powell, that why they're going to be late, is they're using one of the most laggard indicators to decide about what should be done going forward to, try to head off, to be ahead of the curve. You can't do that. Labor's going to be the last thing to give, particularly in the U.S. now, because, there's been a labor shortage. The companies are trying to hold on to their workers longer. That will change as things worsen. At some point, it will cross over they'll react as they always do and say, we got to cut costs, we got to lay off people. I do think the unemployment rate's definitely going to be going up sharply more next year than this year, but it's going up probably the second half of this year. I'm on the record as saying, and I've said it many, many times in the last few years, the easiest part of my forecast is how the Fed will respond, how the policymakers will respond. I'm saying the possibility is there, and I think very good likelihood, that what it's going to take to turn the bust around, you're going to see the Fed expand the balance sheet by $20 trillion. So they expanded by $5 trillion in the pandemic, so it got to 9. I would not be surprised to see $30 trillion in terms of the Fed's balance sheet by the time we get through the bust. And everybody's worried about the deficit now and government debt. You'll have not necessarily matching $20 trillion, but you could have certainly half of that $20 trillion in terms of new debt. Use 2020 as an example, not for the same reasons necessarily, but they came out with all kinds of government programs because they had closed the economy down and had to turn things around. They had to support the bond market. They had to support, they came out with all the loans, etc. You're going to see something like that on steroids, I think, in response to the bust. So, as I say, I'm not endorsing this. I'm saying this is inevitable, that if we get the bust, the easiest prediction I can make is that you're going to get this kind of a response because, as you say, when faced with a choice of either future inflation, future concerns down the road, or the free-falling system now, they'll deal with the free-falling system now and do whatever they have to do to stop it. Because I'm calling for an 80% peak-to-trough decline in the stock market once we peak. 80%. We haven't seen anything like that since 29. So that's a big statement. But why do we get that in spite of the Fed, turning on the printing press? Because of 2008-9, basically. Because the Fed in 2008-9 obviously went to levels we'd never seen before. We printed 3.7 or 8 trillion in new money in the next decade after that. QE 1, 2, and 3. Then we had the 5 trillion in the pandemic. So what does Powell say? Powell said, we're not going to do that again. He's very adamant that, first of all, we're not going to backstop the market. We're not here. There's no Fed put. And secondly, we're not going to follow a policy like that one because that one was so criticized and caused so many problems. And I believe him. In his mind, he thinks he will not go back to zero interest rate policy, back to printing money like that. That's easy to say until you're faced with what he does not realize is coming. When he's faced with it, you'll see it on steroids. But that means his initial response to that will be gradual. When the system's probably calling for 3 or 4 trillion, he'll be doing less than a trillion. And then when that doesn't work and the system's calling for even more than 3 or 4 trillion, he'll do another trillion. It's not just the Fed turns on the spigot. It's does the Fed turn on the spigot to a right size? It takes time to get that right size that will stabilize things. I'm guessing that'll take many months. And in the process of waiting for that to get there, because number one, he's in a mindset that says, I don't want to do that again. And number two, you're facing something we haven't faced in 90 years in terms of the magnitude of the decline. The combination of those two things means it's going to take time for them to figure it out. And in that time that they're not figuring it out, things could free fall.